Hong Kong stocks plunged 6% as fears about Xi's third term Trump. China GDP data. Xi broken almost all norms. CNN Beijing bureau chief react to China's new leadership. Hong Kong CNN Business. Hong Kong stocks had their worst day since the 2008 global financial crisis, just a day after Chinese leader Xi Jinping secured his iron grip on power at a major political gathering. Foreign investors spooked by the outcome of the Communist Party's leadership reshuffle dumped the Chinese equities and the yuan despite the release of the stronger than expected GDP data. They are worried that Xi's tightening grip on power will lead to the continuation of Beijing's existing policies and further dent the economy. Hong Kong's benchmark, the Hang Seng Index, plunged 6.4% on Monday, marking its biggest daily drop since the November 2008. The index closed at its lowest level since April 2009. The Chinese yuan weakened sharply, hitting a fresh 14-year low against the US dollar on the onshore market. On the offshore market, where it can trade more freely, the currency tumbled 0.8%, hovering near its weakest level on record, and even as the Chinese economy grew 3.9% in the third quarter from the year ago, according to the National Bureau of Statistics. Economists polled by Reuters had expected a growth of 3.4%. The sharp sell-off came one day after the ruling Communist Party unveiled its new leadership for the next 5 years. In addition to securing an unprecedented third term as party chief, Xi packed his new leadership team with staunch loyalists. A number of senior officials who have backed the market reforms and opening up the economy were missing from the new top team, steering concerns about the future direction of the country and its relations with the United States. Those pushed aside included Premier Li Keqiang, Vice Premier Liu He, and Central Bank Governor Wei Gang. It appears that the leadership reshuffle spooked the foreign investors to uproot their Chinese investment, sparking heavy sell-offs in Hong Kong-listed Chinese equities, said Quan Cheng, chief Asian forex strategist at Mizuho Bank. Officials watched the opening session of the 20th National Congress of the Communist Party of China on the TV in Qingdao in East China's Shandong province Sunday, October 16, 2022. The GDP data marked a pickup from the 0.4% increase in the second quarter when China's economy was battled by widespread COVID lockdowns. Shanghai, the nation's financial center and the key global trade hub, was shut down for 2 months in April and May, but the growth rate was still below the annual official target that the government set earlier this year. GDP data fails to lift the mood. The outlook remains gloomy, said Julian Evans Pritchard, senior China economist for Capital Economics in the research report on Monday. There is no prospect of China lifting its zero COVID policy in the near future, and we don't expect any meaningful relaxation before 2024, he added. Coupled with the further weakening in the global economy and the persistent slump in China's real estate, all the headwinds will continue to pressure the Chinese economy, he said. Evans Pritchard expected China's official GDP to grow by only 2.5% this year and by 3.5% in 2023. Monday's GDP data were initially scheduled for release. on October 18 during the Chinese Communist Party's Congress, but are postponed without explanation. New leadership bodies ill for the outlook. The possibility that policies such as zero COVID, which has resulted in sweeping lockdowns to contain the virus, and the common prosperity, she's bid to redistribute the wealth, could be escalated, was causing concern, Chong said. With the Politburo Standing Committee composed with President Xi's close allies, market participants lead to implications as President Xi's power consolidation and the policy continuation, he added. Mr. Kotecha, head of emerging market strategy at TD Securities, also pointed out that this disappearance of pro-reform officers from the new leadership bodies ill for the future of China's private sector. The departure of perceived pro-stimulus officers and reformers from the Politburo Standing Committee and replacement with allies of Xi suggests that common prosperity will be the overriding push of officers, Kotecha said. Under the banner of the Common Prosperity Campaign, Beijing launches the sweeping crackdown on the country's private enterprise, which shook almost every industry in its core. The market reaction, in our view, is consistent with the reduced prospect of significant stimulus or changes to zero COVID policy. Overall, prospect of the re-acceleration of growth are limited, Kotecha said. On the tightly controlled domestic market in China, the benchmark Shanghai Composite Index dropped 2%. The tech-heavy Sancheng Component Index lost 2.1%. Huge sell-off. Hang Seng Tech Index, which tracks the 30 largest technology firms listed in Hong Kong, plunged 9.7%. Shares of Alibaba and Tencent, the crown jewels of China's technology sector, both plummeted more than 11%, wiping a combined $54 billion up their stock market value. The sell-off spilled over into the United States as well. Shares of Alibaba and several other leading Chinese stocks trading in New York, such as EV companies NIO and XPeng, Alibaba rivals JD.com and Pinduoduo, and the search engine Baidu are all down sharply Monday. Correction: a previous version of this article gave the incorrect today when Chinese stocks trading in New York are down.